And welcome back to WealthWise with me, your host, Jordan Kimmel. And we have a great show lined up today. We have Mish Schneider over from Market Gauge, and she's made a couple of tremendous calls so far in both the Pro Investor Insights and the WealthWise show. So we invited Mitch back on to see what the morning and what the year looks like to her early in this year. We'll also have on the senior economist from Interactive Broker. We've seen Jose Torres on several times. And the story right now is people are talking about the yields backing up and market looks very different. I'm not sure that's exactly what the story is. But what I wanted to share before we bring on our guest is the first 5 minutes in the December newsletter of Pro Investor Insights. I shared the returns of the models of the portfolio we put on in just the 6 months since we started. And yes, I shared they're extraordinary. And yes, I shared that I wasn't gloating, but that I felt that this year's going to look a whole lot different. And what I suggested is that there's going to be a pent up desire to sell some of the big winners from last year, people waiting to pay taxes for the following April, and that this year would start off and it would look very different. Well, you know what? It does. And we are seeing right now some of the leaders taking to the woodshed in the weekly update that I like to put out called the week ahead. I talked about two things I observed going on in the market right now. And we could say this is not like dot-com bust, but it's actually worse. It's more severe. It's more strange in that we didn't have back then leverage 3 times ETFs on individual stocks where people not only are buying and selling these 3 times leverage, but they're buying calls and puts and options and day trading, on these 3 time ETFs, which is just exaggerating all the moves and sending the bots into hyperactivity. Now, what I saw, and I mentioned in the weekly piece last weekend, is yes, there's a thing called fart coin. And while they talk about there's a limited number of Bitcoins, what I suggested would happen, they'd split it or find another way to dilute the coin space. So now we have thousands of coins trading. Bartcoin made the big move last week. Yeah, you heard me right. And it now has a market cap of 1.5 billion, larger than some of the real high quality small and mid cap companies that I'm interested in. So is it weird? Yes, it is weird. The second thing I mentioned is you saw this thing, quantum computing stocks take off late last couple months ago. They made moves from $1, $2 to $30, some from 2 to 100. But there's a problem here, folks. And the thing is, quantum computing is still a way off. And I'm extremely interested in it. I think that there's a possibility in the future that there will be some quantum computers that the big boys own. The idea of everyone having it and these stocks with virtually no sign of revenue, no chance of revenue, going up 50 times in value in a month. It tells you that the bots are out there, that the maniacs are out there, and it's a great time to stay grounded and just not get caught up in the hysteria. Now, in 2022, to the end of the year, I took a snapshot of several of the highest flyers, the most stocks in demand that turned out again to have great 23s and 24, 2 great years in a row. But Nvidia, folks, was down 70 odd percent in 22. There's a basket of these companies, including QQQ, the thing that can't go down. They're all down an average around 45% for the year. And welcome back to WealthWise with me, your host, Jordan Kimmel. And you see her all over. It's Mish Schneider. We've had her on before. She's given us some of the actual very best ideas, the Pro Investor Insights newsletter. Good morning and happy New Year, Mish. Thanks for joining us. Mish, thanks so much for joining us.
Thank you. I'm sorry, I just said you froze, but you're back. Well, thank you so much for having me. Happy New Year to you. And yes, it's certainly starting out as an interesting January.
Yeah, well, you know what? December was kind of, a very rough time for the market as well. People were still saying things like, well, we're up 20% for the year, we'll still take it. Um, I had said, and I had said so firmly in the last newsletter we did together, that's going to be a very, very different year. And people were really waiting to sell some of these winners until January. And then they have a whole year to pay those taxes. This is what I thought was going to happen. It's a messy year. Mish, you tell me what you see. I know that the whole point of our shows and our newsletter is to get different views. Tell me what you're seeing.
Well, one of the things I wrote was a pretty lengthy outlook for 2025, by the way. Shameless plug. You can get it on our website, marketgauge.com. And it's free. And in it, my thoughts for 2025 were exactly what's happening so far, which is that January would start out possibly into the first quarter with volatility, maybe a little bit of a sell-off, house of cards, uncertainty, and that makes a lot of sense. But then things might straighten themselves out in the spring, possibly with a Fed pivot being in there, not necessarily good for all of the market, but maybe good for the small caps, which many people are looking for to outperform this year. Right now, that's certainly not the case, but we'll see. And that by the end of the year, we will not see the massive gains that we saw in 23 and 24, but we'll see more marginal gains, more around 3-4%. That's my big macro drop. To put a little bit more of a fine point on it, we are extremely positive about this January calendar range in a new administration year. We use it every year. It's a 6-month calendar range, resets in July. But particularly this year, 2025, we have a couple of things. The number 5, which if you go back 13 out of 14 times since 1880 has wound up being a positive year. The one exception was 2015, interestingly enough. We have the year of the snake, and I know people like go, ha, 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 what is she talking about here, astrology? But 1.7 billion people on the planet believe in it, right? The Asians, number one. And number two, in the year of the snake, this is the Yin Wood snake, it has been a mixed results through the years. But the last one was 1965, interestingly enough. We had Lyndon Johnson as the president at the time, not that I think that makes a difference, but it was a tumultuous start of the year that wound up ending up with a small gain with a lot of geopolitical concerns and, all of that. So that's why all of this, and that, of course, with the PE ratio projection with Kay Schiller saying the next 10 years, earnings will only be nominal compared to where they've been. All of this means that that's probably the case. So that's the wide umbrella. Going back to the calendar range, essentially, we use the first 10 trading days of the year. So we're not there yet. And then a range is set. And what we find is that we think that things that break out will be either supportive to the potential Trump administration or in spite of the Trump administration.
Okay.
Things that break down will break down, and things that sort of chop in the middle will need to find some kind of resolution before you get involved. So that's what we're waiting for very patiently, and it's only another week away. And I think that will tell us a lot more information. Is it going to be commodities that break out? Is it going to be the growth stocks that break out again like they did? Is it going to be the small caps? I mean, right now they're under a lot of pressure, but we'll see. So I think this is a good year for two major things. Ignore headlines because they'll drive you nuts.
It's always a good idea.
Well, yes, but now we have a president that's he loves headlines. He loves headlines. And a lot of them are nothing more than just that. A headline, mean nothing. And number two is get some kind of an idea of what price action looks like on a chart. I say this every year, but I think
Well, let
this,
me let me let me jump in here for 1 second because
sure,
I
go
was
ahead.
watching an interesting video earlier in the weekend, and I don't know why, but I still love to do that. I love other people's point of views. And this guy was saying something interesting to me is that he went strictly to weekly charts, doesn't look at daily charts anymore. That it made him do too much, made him too active, made him too anxious. When you look at time frames, tell me, Mish, what's your leading time frame, and then maybe do you go to other time frames to look at different, time frames?
Well, first of all, I love that. If you did I send you my book? Did I send you?
No,
Oh,
not yet.
oh God, Jordan, I have to send it to you, signed copy. But anyway, my book is all about the weekly time frame using the 50 and the 200 week moving averages and determining phases. So I find that to be extremely reliable. Obviously the daily charts might be better for some short term and particularly really good at telling about reversals, major reversals. I mean major bottoms or major tops. Monthly charts, though, for me are also interesting, and I use a 23-month and an 80-month because what
Wow.
that does is it gives you roughly a 2-year and a 6 to 7 year business cycle sense about any instrument. And you can see if something is contracting, in contraction, expanding, or in expansion. And I think that really helps when everything else sets up too. So my whole outlook was monthly charts using those two monthly moving averages
Interesting.
because I'm looking
Okay.
out for a year,
That
right?
gives you a nice long time frame.
Yeah,
That's really
exactly.
interesting.
But let's take a look at corn futures, by the way. Corn futures right now, which are something I'm very, very interested in. I wait for two things now, and I'm so happy because they're setting up in perfect alignment. We technical people love perfect alignments, right? One would be a
Okay.
breakout of the 50-week, which it has not been above for a couple of years. The other would be if it breaks out of the highs of the January calendar range. And if those two match, I will buy corn futures. Okay, but that's one thing. The other thing is what are the implications? Because people are really on the fence. Some people think we're going into massive deflation. Some people think reinflation. I say it doesn't matter. If you get a breakout like that in a basic staple corn, that's going to tell you stuff and you can buy that instrument. And I know this is educational advice only, right? By the way, disclaimer, not trading advice. But that's the type of instrument that sets up technically and also fundamentally tells a different story.
Right. And so commodities are really interesting, and I don't really do any work with commodities other than occasionally going long gold, but we don't trade copper. We don't really trade any of the commodities. The thing I want to point out here though, um, when it's corn, I like corn, you like corn, you may not like corn. It is a pure commodity. What I'm seeing taking place though in the market right now, and now I go back to the stock market, is just what I consider insane action in terms of maybe it's just charts, maybe it's bots, maybe they're saying if the 10 days over the 8 day, which is over the 6 day, just keep buying it. What I'm talking specifically is something I mentioned in our um weekly update. I talked about, quantum computing stocks. Some of them went to from $2 to 100 in about a month. Um, lots of these companies went up 1,000 times in value in 1 month. And Mish, what I'm asking you, like, who's buying that? Who was doing that today? The balloon popped. A lot of these
Because
stocks are down
Jensen,
already 50%. But
right,
the thing is, I'm interested in quantum computing. There is no quantum computing, and there will be none for a while. And when there is some quantum computing, there will be the most expensive computers owned by only a few of the largest companies.
right.
What I'm saying is things got weird, Mish. Bartcoin, Bartcoin is now more valuable than a lot of really good companies that I'm invested in. So I know things are nutty, and they say things are not as bad as 2000
Mm-hmm.
.com. What I'm going to say, and I said it before we came on, is that we didn't have in the year 2000 triple ETFs where people were buying
Leveraged.
calls and puts on triple ETFs on individual stocks. Things have gotten wacky and weird. And what I'm suggesting is use stops, use your charts. But Mish, when someone was saying the quantum computing stocks were bullish last week, what were they talking about?
Okay, so that's a lot of questions right there, but let me try to make that answer very simple. First of all, since the history of trading, and particularly you're not much into commodities, but remember, I spent 14 years on the commodities exchange. Moves like we saw in the quantum computing stocks are not alien to commodities traders, right? They make parabolic moves for all kinds of reasons. Herd mentality, could be bots, leverage ETFs now, something we didn't have back in the day. But you get a massive amount of speculation in something, and it drives the price into a parabolic move. And we know as traders, that's a lot of fun to capitalize on. And then there's all kinds of rules, not only for risk management, but for adding to those kind of positions to catch the momentum. And then they just as easily die, right? So this is not surprising. This is the newest thing. A few years ago, it was 3D printing. 3D printing looked like it went up to like 200. Out of the gate, it went crazy. And now if you look at 3D printing, I mean, it's just like it died. It died and it hasn't revived yet. So, so now quantum computing, just like 3D printing, has a real fundamental story, right? I mean, 3D printing is something that is used. And quantum computing is something that will be used. So the question is, that's where you step back and you say, what companies are doing quantum computing, not just as the new fantangled thing, but forever. That's why I'm looking at IBM. IBM has been doing quantum computing since 1990. They're already profitable in that realm.
So here's the problem. We're going to bump up against time right now.
Oh, God.
I'm going to say this to you, Mish. I don't think, and you might be right, I don't think that there is a quantum computer working. IBM may have been involved in a lot of the research.
Right.
When you talk about cooling and heating things below the core temperature of the core of the Earth, or it's a little far-fetched, but we're bumping up into time. What we're trying to do here, and what I'm just really the point I was trying to make, is that the stock market, even if there's wild moves, should be grounded in some sort of reality, some sort of reality, some sort of price earnings, price to sales, price to speculation, price to anything. When you see things that are going up and they are 1,000 times the 200-day moving average, you know these people are going to be burned and incinerated. And it's tough to watch. It's a moment in time that I think once I see Fartcoin making the news, I know it's probably best to take a break, take a walk around the block, make sure you're grounded in some sort of fundamental. But unfortunately, Mish, we're bumped up against time. We want to have you on frequently. I know you make time for us periodically. I hope you're going to have another article in the Pro Investor Insight magazine newsletter that's going to come out on the 15th. But Mish, I want to wish a happy new year, a healthy new year. And the very next time I eat an ear of corn, I'll be thinking of Mish Schneider and hoping it took out the 200-day or the 50-day, whatever you
50
wanted it
week,
to
50
do.
week, 50 week.
50 week.
Or 60. That's the level in March future.
Well, you know what? It's your experience that keeps you, on the right side of the market. What I'm saying, Mish, is people without your experience, I think a lot of them roadkill. And I just wish everybody a healthy new year. Most importantly, get some discipline, use some discipline, and recognize chasing something that has been on a meteoric tear is usually not the way to make money.
Unless you're disciplined. Right. And
Unless you're
sometimes
disciplined.
you can throw caution to the wind, like a roaring kitty type trade where you get in, you catch it, you get out. That's the discipline, but getting in may be throwing a little bit of the caution to the wind. And that's okay as long as you have a risk parameter.
Well, we're going to wrap it up. It's Jordan Kimmel signing off for WealthWise right now. We're going to be right back with Jose Torres, the senior economist over at Interactive Broker. trying to figure out what's going on with the yield and what the effect on the stock market. We'll be right back with WealthWise. Mish, thanks so much for your time again.
Thank you, Jordan. Thank you so much. And thank you, Todd.
See you soon.
Bye.
See you soon. And welcome back to WealthWise with me, your host, Jordan Kimmel, and it's Senior Jose Torres, and he is, of course, the Senior Economist over at Interactive Broker, where we happen to have our account, and we're thrilled to have him back. Jose, I've been actually seeing you in so many places in the media lately. I don't know how you sleep or have time to write, but thanks so much for joining us today.
Thanks for having me, Jordan, and thanks for your business. We appreciate it.
All right. Well, I love the firm. I love the service. And I'll just say, we could be anywhere we want to be, right? So let me just mention something to begin with, because it's really your ball of wax. I said in the beginning of the year, stop paying attention to the Fed. Rates aren't really the story, but somehow rates are the story right now, as we're seeing the long end bump up to the highest yield we've seen in a while, adding pressure onto the stock market itself. Um, Give me, if you will, a new year expectation on maybe what we'll see in the beginning of the year, the end of the year, where rates will, end up. And is this fear of accelerating or rekindled inflation the thing that's going to break the markets back this year?
Well, I think the main reason why rates have been lifting is increasing growth expectations. I'm seeing the cyclical sectors begin to reaccelerate. Sentiment and confidence following the election result has been more robust. So I'm expecting that to be the main driver. But inflation, like you said, is a critical risk. We're not sure that it's going to increase, but there's a high chance that it will. And the reason is President Trump's tariffs and trade policy may end up being positive for the U.S. in the medium to long term, but not without Trump bumps in the short term. Right? That's what I've been calling them. The turbulence, the volatility needed to get across the bridge, right? So when you consider goods, physical products, that's what's driven the disinflation train from 2022 to those high numbers we saw, 8%, 9%, down to the two handles we've been seeing recently. So with inefficient trade routes and problems geopolitically with trade partners, namely China, Canada, Mexico, etc., there's a threat that goods inflation is going to reignite and then bring the CPI back to 3.5%, 3.4%, which, by the way, I don't think will be terrible for equities. I think equities do fine in a 3 to 3.5% CPI regime when the Fed is not apprehensive. If the Fed is all right with that for the time being, equities can do great. However, Jordan, if inflation starts going up to 4%, at that point, the Fed has to become apprehensive, and then we get back into a 2022 kind of market, which is, more tilted to the bearish side. Now, another factor with inflation is the labor market. We already have scarce labor conditions. We don't have that many skilled workers. We have elevated wage pressures. We saw that this morning, January 8th, in the ADP report. So President Trump's immigration policy, again, could be positive in the medium to long term from a structural perspective, but in the short term, who's going to replace some of those illegal workers that are contributing to the economy today, right? So that can drive inflation higher as well. So I think those are the two main wild cards with President Trump approaching Inauguration Day on January 20th is going to be the uncertainty on goods and trade, but then also the worker, labor, immigration story.
Right. So look, I think you mentioned some really important points there that you kind of, because you're so ingrained in the forest. I want to bring out the points a little bit further. So For 100 years, we've seen inflation, and especially in the mid part of the last century, was always 2-3%. And what was actually looked at was, if a company did 2-3% unit growth and then 2-3% inflation, well, earnings would actually grow by 6%, and it's actually good for the stock market. And what I think you were mentioning with the market and the bonds is that it's more normalized, Jose, in that some people who haven't been around for a long time were used to, or thought the free money environment was the normal environment, and that was anything but. So when I was growing up, you get 5% in the bonds, you got 10%, 8% in the stock market, maybe 10. And if you had a good model and you were a little bit better, maybe you can get 12, 13, 14%. But this idea of zero interest rates or free money or prices going down to zero inflation, it's not realistic. It's a good way to sell yourself and to get some votes. I love a certain amount of Trump's policies themselves, but this concept that inflation's going to 0 or 2 or 1%, I think it's ill-founded, and I wish they'd stopped. I wish they'd stop trying to have 2% as the goal, which they constantly talk about. That's my feeling.
In the medium term, Jordan, when you consider the difference between 2 and 3%, sometimes we see, oh, it's just 1% higher, but it's really 50% higher. And when you compound that extra percent over 10, 15 years, it ends up being quite significant, which is why I said earlier, you have that moderate inflation at 3%. It's actually great for earnings per share, like the example that you brought. Earnings per share are not adjusted for inflation. So to the extent that we have a 3% inflation economy and the Fed isn't apprehensive, then that really gives earnings a lift and allows profits to catch up to some of this valuation expansion, which has been, quite elevated. And going back to those old days, when risk premium used to mean something, right? You would essentially look at what the 10-year was paying right now, roughly 4.7, and then you look at the earnings yield on the S&P, and you sort of subtract from that
Exactly.
to see what kind of extra return am I getting for holding equities, right? And that has been exceptionally narrow, but the whole dynamic of growth, tech, AI, those new technologies that can make businesses in America more efficient, widen those profit margins, right? That's been an integral reason as to why valuations have expanded so much. So those risk premium calculations that we remember from the old days, when you factor in the growth that could occur in the next 3, 5, 7 years, right? The 10-year bond, the 2-year bond doesn't have earnings growth the stocks
Right.
do. So that's something to reconcile for those folks listening that are looking to deploy capital.
Right. So you bring up a point, and I wrote about it, and I asked you about it, and I asked you to come on to talk about it to see how off base maybe I am. But the thing is that when I remember in the 80s and the 90s, they talked about technology bump and there'd be more productivity coming from it. Well, this new thing that showed up called AI, I'm more interested in the machine learning part of it, where you could train a company on their own data and ask the machine how you could make them more efficient. And I think that what you're bringing out is there are billion-dollar conglomerates, United States, making everything from machinery to paper, all of which are going to undergo some structural technology improvements, make just minor gradual improvements. And I think what you just said is that the bad news is out there, supply chains. We hear all about all the problems, but the underpinning of technology making companies more efficient is more of a gradual thing. It's more behind the scenes. But man, do I think it's going to have a gigantic impact. And those companies that can harness that technology are going to be the stocks I actually want to invest in.
Yeah, absolutely. Interesting trends, and we know technology has driven a lot of the growth since the dot-com era to today. And I agree. I think a lot of the automated processes, especially against the backdrop of President Trump, we could have those labor scarcity concerns, worsen. That's a way for companies to respond to a lack of highly skilled labor or skilled labor is to really implement a lot of those machine learning tactics and a lot of those policies of artificial intelligence, et cetera.
Right. And you know what? I want to point out further, I mentioned this with you on the show on a previous when they talked about the non-farm payrolls and how many people working on farms. Well, Jose, right now they're actually it's a new machinery that's running these big farms, and they have machines with 80 arms on them, literally going down and harvesting on their own, but embedded with some AI machine learning, knowing when it has to be watered, knowing when it needs to do certain things. So these farms are one example of the productivity. I think what you're going to see, just like they merge biology and technology and they get biotech, I think what you're going to see in I'm calling it, I can't say it out, I can't pronounce it. I'm calling it Indus Tech. We got to figure out a better way to say it. But I think industry is going to see exploding, even not exploding, just gradual profit margin acceleration makes companies really, really desirable. And I do think we're going to be in some sort of normalized economic condition. We'll be looking at rates. But so let me just bring up one more technical thing before we kind of run out of time here. I have a guy who's just a chartered technical analyst. He's not fundamental. He just looks at charts. And he sent me a note today saying he would buy any instruments that would profit from lowered interest rates, thinking that interest rates just jumped up to a point where they may be peaking right here. So this is the hardest question of all, asking what's the next move in interest rates? You want to kind of bite on that one?
Absolutely. We're going to see a bear steepener. The 10-year is going to exceed 5%. I'm at odds with the technical
Ooh,
analyst. I think the long
interesting.
end goes higher. When you look at averages in terms of normalization, right now we're roughly 40 bips of width, twos versus tens. Historically, you can see that at 100, 150. Not saying that we're going to go there, but I think the 2-year right around 4.5 and the 10-year maybe at 5.1, 5.2. I think that's going to be the environment we're in when you consider strong growth with President Trump. No, there's no recession. No one's talking about any kind of recession. A lot of sentiment boost, buoyancy, inflation, uncertainty. We spoke about earlier. No need to talk more. But goods and labor, right? And then finally, term premium and the fiscal imbalances, right? We know Musk and Ramaswamy and that group and Bessent, they're talking about balance, but we have to remember President Trump is a populist. He wants to give the goodies out. Remember
Yeah.
2020 stimulus checks. President Donald J. Trump, his name was on those checks. So he's at odds, with the folks that want to embrace those austerity measures. The man is a populist. For that reason, the long end goes higher.
Yeah, well, you know what? I'm going to agree with you, and I appreciate you being not wishy-washy. Again, he's the guy, I call him the one-armed economist. He doesn't like to say on one hand or the other. I really appreciate the conviction that you have. I think that you're right. I also think that if you're in the right companies, it's going to be okay anyhow. And I just really advise people not to lose their discipline, not to get caught up in hysteria. And Jose, I think that you brought it, home today. I also want to remind you and our listeners and our viewers, the Pro Investor Insight newsletter is going to come out at the end of next week. So we're looking forward to a contribution from you. And we know that the stock market, to me at least, is the more interesting part of the market. But if you don't have your economics and you don't have your interest rate guide and you don't understand how those all work together, They're missing a lot, and that's why we love to have you on, because it's one of the most important parts of understanding the market is understanding the economy and the relationship. So Jose Torres, the senior economist over at Interactive Broker, we call him Senior Jose Torres, and he's a superstar, and we really appreciate your time today.
Thank you, Jordan. Thank you, everyone. Looking forward to next time.
We'll see you soon. Thanks again. It's Jordan Kimmel wrapping up with Jose Torres, a future member of the Fed, I believe, and earning his chops on the way there. We'll see you all soon. Thanks for the time today.
If you like Buy, Hold, Sell Live, be sure to smash the like button.